So we're going to pick up here with our business expense discussion with transportation. For a self-employed person, certain transportation expenses are deductible. Certainly, if the person is traveling for business purposes, maybe to a conference, or they see customers or have jobs that require travel by airplane, rail, bus, whatever, they can certainly deduct the cost of that travel. If there is an automobile that's used either entirely for business or partially for business and for personal, the portion that is allocated to business purposes, again, certainly deductible. Now, what happens when the taxpayer's home is also their business? If that's the case, then the cost of going to the first job in the morning or out to see the first client or something like that, that cost is certainly deductible. Now, that should not be confused with costs of commuting, which are not deductible. So if a business owner has a separate work location and has to drive from their house to that work location, not a deductible expense, just as an employee can't deduct the cost of driving back and forth from his house to his job. If there are temporary work locations, though, and the taxpayers, going someplace other than to the work site first thing, they may be able to deduct that. If there's a job in another state and the taxpayer is leaving their house and going straight to that work site, then that can be deductible as well. And if there is tools and equipment to be hauled, in any instance, as long as the trailer is hitched up to that truck and it's headed out the door for a business purpose, then that cost of transportation is deductible. Now, don't think you can hitch that trailer to the truck and then decide you're going to drive it around for personal use at all times and then deduct that. I think the IRS is going to take a dim view of that. There are two ways, again, that we can calculate transportation expenses. There is the standard mileage deduction, which changes sometimes more than annually, and it fluctuates based on gas prices. So there are certainly times where gas prices have changed substantially in the middle of the tax year, and the IRS has said, okay, travel from this date to this date is reimbursable at a different rate, either higher or lower, depending on what happened with gas prices. So it's really important, especially for that reason, that records are being kept all along, because you might have a tax year in which you're dealing with multiple mileage reimbursement rates. Maybe they changed as of May 1, for example. So you have to know how many miles were driven up until May 1, because you're going to deduct that at one mileage reimbursement rate, and then from May 1 till, whenever they change it again, because that will be deducted at a different rate. So if you are not taking the standard mileage deduction, then actual expenses can be taken as well. So the things that are built into the standard mileage deduction include gas, oil, insurance, repairs. And so if you are not taking the standard deduction, you can separately add those things up. And it may be more if you've got a vehicle that's very costly to maintain or very costly to drive, or maybe you're putting the premium gas in, or maybe you have exorbitant insurance, and that's something that if you were to add it all up, it would actually be more than the standard mileage for the same miles driven. Then you may want to take the actual expenses. Anything that is parking fees, tolls, things like that are deductible. Interest on car loans. This is something that I wrestle with sole proprietors on with some degree of frequency. The car payment is not the deduction that one takes if one has a loan on a vehicle or really any piece of equipment. What is deductible from an expense standpoint is the interest expense on that loan. Remember, capital expenditures are not expenses. And the portion of the car loan that's really paying off the principal amount of the vehicle purchase, that's capital. That is not an expense. Again, something we will get into later. You're probably sick of me saying that already, but when we get into it later, I promise I'll quit saying it. There are some jurisdictions that have personal property taxes, and if that's the case, then that would be deductible as well, as it related to the business property. So if the standard mileage rate is being deducted, the taxpayer has to be the owner or lessor of the automobile, and it can't be a fleet. So if fleets are being used, then you've got to take the standard. And you can't separately claim depreciation using anything other than straight line. You can't use an accelerated depreciation form. And you can't take a 179 deduction. And I won't say it, but you probably know we'll do that later. Anyway, if you don't use the standard mileage method the first year, you can't do it after that. So if you think you might want to switch at some point to the mileage method, might behoove you to start out that way. You can certainly switch to the actual method at some point later, but if you don't do that standard mileage the first year, then you've committed yourself at that point. So as I said, you can do the actual expenses, and you can deduct depreciation, you can deduct gas, repairs, oil, all that stuff. And what you need to do if you've got a vehicle that is a combined business and personal use, again, is to allocate. You take the total miles driven, and you take the business miles driven, and you determine what percentage of the total miles driven that vehicle was used for business purposes. Then you add up you take all the expenses, and you then just take the percentage of business use and apply that to the expenses to come up with what is deductible for business purpose of the car. And again, parking, tolls, fees, all that stuff is separately deducted. Vehicle expenses are reported on form, that says 2016, it's 2106, and then are carried over to Schedule C. The portion of Schedule C that you saw that was toward the bottom, we do record some things on Schedule C, such as the date the vehicle was placed in business, what kinds of records we have, and the total mileage, but the actual breakdown of actual expenses, things like that, gets reported on 2106, and then the whole amount goes over onto the top area in the expenses of Schedule C. So now we're moving from transportation expenses to travel expenses. To be deductible for travel, again, it's got to have a business purpose. If you are going to a conference in Hawaii, let's say, nice place to go to a conference, if you are deciding that you're going to stay an extra week, for example, or take your spouse, the entire thing is not a business expense for tax purposes. Only the portion that is for the business owner, that, unless of course the spouse is part of the business, in which case then the spouse's expenses could be deducted as well. But only the portion of the travel expenses that are related to the business purpose are deductible. Extra hotel nights, things like that, you can't deduct. The cost of meals is only 50% deductible. Basically, they figure you've got to eat anyway. Yeah, okay, you're probably spending a little more, so they'll let you deduct half of the amount that you spend for meals on the road. You can deduct lodging, taxis, tips, laundry, although, I don't know, I've never done laundry while I travel, or never sent it out. Anyway, We have to substantiate the expense. You can't, no lavish and extravagant. It's got to be sort of commensurate with the kind of level that you would be spending on other business operations. And you have to be away from home overnight to be able to have it considered travel expense. And it doesn't necessarily mean 24 hours. It just means that basically longer than an ordinary workday. And it's got to be away from your home. Now, there may be instances where you may have to take on some lodging for a long-term situation that is more than just a conference or something like that. If you have to rent an apartment or something like that for a temporary assignment, you can deduct that as an expense if it's not practical to go home every night. If it's more than a year, then they're going to consider that a second home. So this is really just for short-term assignments. And as I mentioned, you got to be careful with the travel. If you're going to deduct it, you have to take some things into consideration. If it's within the U.S., all travel to and from the destination are deductible. But again, only the business portion of the meals, lodging, and transportation can be deducted. Similarly, again, if you're taking the spouse, if the spouse is not part of the business, the spouse's expenses are not deductible. If the business trip is outside the U.S. And there are business and personal, then you've got to split the destination or the expenses between business and personal based on the number of days that you're there. So if you've got this really great conference in France and you are going to show up on the first day of the conference and you are going to leave on the last day of the conference and you are going back home, then your travel expenses are deductible. But let's face it, who's going to go to a conference in France and not tack on a few extra days? I certainly would. And so because it is primarily business purpose, but you've got some extra personal time, you've got to allocate the travel to and from on a sort of a prorated basis between the amount of time you were there for business versus personal. If this business within or outside of the U.S. is clearly more of a pleasure trip, and you just happen to do some business while you're there, you can't deduct your travel costs. While you're doing business, anything you deduct for anything you incur for business purposes is deductible. So this is an interesting example. I was at a conference in Tucson, Arizona, at a lovely resort. And I bumped into the spouse of a colleague that I never see at these things. And I thought, oh, how exciting. Somebody from home has traveled here. And I said, oh, where's your spouse? The program's starting. And she said, oh, we're not going to that. We're going antiquing. And so basically, they had really no intention of attending any of the conference. And we're deciding, my guess is, to take a tax-deductible vacation. I'm not sure whether they actually attended any of the program or not, and I guess I will stop my analysis there. But certainly, from a purist sense of the word, that sounded to me much more like a pleasure trip, in which case nothing was deductible, and if they happened to wander into some of the conferences, any expenses related to that, they could have deducted. So here's an example. We've got Gretchen, a sustainability director who travels from Idaho to New Mexico for a business trip and pays $380 in airfare. So we've got within the U.S., the lodging and meals costs are $330 and $150 respectively for the business portion of the trip. While in New Mexico, she goes on a personal sightseeing tour of the Turquoise Trail and spends $400 on car rental and lodging and $85 on meals. What amount may she deduct for the business trip? So again, it's within the U.S., and so she can deduct all of her airfare. And so what we basically need to do, of course, none of the car rental for the turquoise trail and anything that she spent on meals on the turquoise trail, not deductible. But anything that she spent for the business related, she's got the airfare, she's got the meals and the lodging for one night. And then the other night is her travel to the turquoise trail, which she cannot deduct. So she can deduct $785 for her business travel. You don't get to deduct this though unless you keep proper records. And I tell you, nothing's a bigger hassle than trying to get out of a cab in New York City for a conference and needing a receipt out of that thing, or going through a toll and having to get a receipt. And it's a super big hassle, but there's no point in not keeping those records, because if they're audited and you don't have them, then the expenses didn't happen and you may end up owing tax because they will disallow those expenses. We'll talk about some instances in a minute where that isn't the case, but definitely document the business reason for the travel. Is it a conference? Are you there to do a job or meet with a prospective client or do an estimate or something like that? Make sure that you break down the costs for the travel. I tend to use Expedia or one of those other sites, and it will pretty clearly set out what I've spent on lodging. And it's not very, once in a while I'll do a bundle and I'll get the car and the hotel and the airfare all in one, but it's nicely broken out so that I can make that determination. And if I decide to stay extra for something, then I want to certainly make note of that as well. Now, for those who don't like keeping track of every little receipt for every hot dog that you happen to buy on the street corner outside the conference location, there is kind of a saving grace for that. And that's called the per diem substantiation. So if you decide, you know what, I don't want to keep every little receipt from every hot dog that I bought. Instead, there is a per diem allowance. Now, if you have an employee that is going to be traveling on your behalf, then the employee all the per diem can be dealt with for the travel expenses. On the other hand, if it's the self-employed person, then it's only for meals and incidentals, so not lodging. And so the rate changes periodically for the per diem amount. And so I think it changes every October as to what can be claimed per day. So I jumped over here so that you could get an idea. We've got the meals and incidental expenses. And so there is a total here. And the total that you can spend here corresponds to the location that you're at. And this is not going to give me the full, here we go. This is just not going to be easy. Okay, well, it's going to make me do something a bit more complicated. There we go. I don't want to survey. But anyway, then this will, this is the lodging, and then this is the meals and incidentals breakdown. And then this will basically tell you if there's not a specified rate, it's the $55, but in these particular locations, and I just happened to click on New York, but interestingly, we've got New York City. Let's see if we I don't know, Niagara Falls. I was just looking for maybe someplace that was more expensive. But it looks like $76 is the highest we get. And so again, you get $18 for breakfast, $19 for lunch, and $34 for dinner. Anybody who has eaten in New York pretty much knows that you're not going to get very much for that. So, but it does, if you choose to take that per diem, it saves you the hassle of collecting and saving and tracking little bitty receipts. So the other per diem method that can be used is what's called the high-low method. And if you've got an employee that's doing a lot of travel on behalf of the business, this may be an easier way to do it. And it's based on high cost or low cost areas. And once you choose, if you're going to do the high-low method for that employee for the year, then you can't just say, okay, well, we're going to do the high-low. Oh, no, we're going to then go do the standard, or we're going to just actually reimburse. Once you commit to that for the calendar year for that employee, you're locked into that until next year. And so I'm going to stop here and go on to the next video for entertainment.